Hey, good afternoon, everyone. Thank you all for joining. I'm Akash, and I am the growth lead at Awesome UK. We are expert property accounting service providers. We help businesses with growing their property portfolio. We're joined today by Ahmed Khan and Abby, both of whom will be talking a bit about their journey, how they got started, key challenges that they faced, the key differences between their buy-to-let and serviced accommodation model, as well as the property mentality, what it takes to succeed within this space. And I'm sure most of you guys have already heard of them, as they've got tens of thousands of followers across their socials, creating content on the property sector. So I guess without further ado, it'd be good to kind of dive into your journey, Ahmed, and how you got started within this space.
Yeah, no, well, thank you for having me on this. A quick background. So I went to university in September of 2013. I studied economics for 3 years. And I think probably like most people, before I went to university, you sort of do the Google search of careers and you try to work out, well, what could I do after finishing the degree? And I remember the time essentially Googling, what pays the most money, and investment banking came up as a main thing where you can make the most amount of money. So I went to university, I applied for different roles within banking, consulting, accounting, and I essentially got rejected for about 30 different roles. They weren't jobs, they were, summer internships, spring internships, graduate schemes, those sort of things. And so by the time I finished in 2016, I kind of had given up the whole job thing, and I gave myself 12 months, and I thought, well, if I can make something work, then I'll continue to do that. But if I sort of run out of time within those 12 months, then I'll start looking for some sort of job again. And the last interview I had was from Deloitte, and it was, I think, management consulting or something along those lines. And I go to the assessment center, and if they gave me a job, I 100% I would have taken it. But luckily, that didn't come through, and I got rejected from that job as well. And as a result, I then started looking into property. Now, the issue or the challenge with property is that when you're starting out and you just finished a job, you just finished university, and you don't have a lot of money, it's hard to buy that first property, right? Because, well, you need some sort of income, or you need a deposit, or you need to have savings or something. And so instead of doing the traditional buy-to-let property investing, I basically started renting properties, and then I would put them onto Airbnb. So, which now a lot of people know as rent to serviced accommodation. Did that for about, I still do that a bit now, but nowhere near as much. But I mainly did that for about the first 3 years. Got quite a few properties in Hertfordshire, in London. I then started managing other people's Airbnb properties, and took a commission. So imagine like a letting agent, you're managing someone's property and you're taking a 20% fee or something along those lines. Saved up the money for my first buy-to-let property. I bought a 1-bedroom flat in Battersea Park for £237,000. I then converted that into a 2-bedroom flat. I then refinanced it. So people who are familiar with a BRR strategy, buying cheap, adding a lot of value, and then refinancing. Refinance, got the bulk of my money back. Use that money to buy the next one and the next one and the next one. So I bought 5 1-bedroom flats, which I turned into 2-bedroom flats around those sort of locations. And then the last few years, I transitioned into buying houses and turning them into flats. So I bought a house and turned that into 2 flats, and then bought a mixed commercial, turned that into 4 flats. Right now, we're turning a house into 5 flats. So that has been the progression. It's it's one step at a time. It's starting from something relatively small, and then building up over time. So going from rent to rents, into 1-bedroom flats, into a 3-bedroom house, into a mixed commercial, and then into not necessarily a bigger house, but a house with a big piece of land, which could be multiple flats. And so that's pretty much the aim there, and hopefully I can sort of continue that in the future as well. But that's been the journey so far.
Thank you for telling us a bit more about your story. Abby, it would be great to hear about how you got started within this space. Sorry, I don't think we can hear you, Abby. No, we can't. We still can't hear
you. It is on mute, so that's a bit strange.
You can, okay,
That's
here we are.
Yeah.
Yeah, perfect. So, hi guys. How I got started. So I went to university myself. I actually studied drama and theatre. So different to what I do now. And then I fell pregnant with my daughter right to the end of university with my long-term partner. So my whole life was so different. You know, imagine 21, pregnant, scared. So when that all happened, the next thing was I specifically wanted to do something where, you know, I'm not in a 9 to 5. I already saw how the 9 to 5 was, and it just wasn't for me. And so I really did more self-development on myself. I worked on my mindset. I worked on so many things in order for me to actually start and grow in property, because when I wanted to do it, but I just didn't know where to start. So I looked at a lot of YouTube videos and I looked at service accommodation. It was a lot of Americans, to be honest, that I was seeing talking about service accommodation. And so I said to myself, do you know what? Service accommodation seems great, but I want something more long term. So long, like rent to rent or HMOs that we say here in the UK. And so I did just that. I went onto Gumtree. I then literally started to make phone calls because I'm an action type of person. I just like to take action and just do it. I took no course in it. I just simply took action. So I did that, made phone calls, and then I had my experience in that area. And that's just been me generally in life, because with me, even at school, my GCSEs, I literally got one GCSE. I literally failed my GCSEs. But, you know, when it comes to grades, it does not define you, because with me, I just realized that I'm more of a person that just likes to action things. You know, like, for example, maths, I honestly hated it. You have a calculator, you know, so I'm just that type of person. So in doing that, that's how I got started, to be honest, in property that way. Yeah.
Sounds very inspiring. I guess a question to you both, just in terms of some of the key challenges, and I'm sure you faced thousands across the way, but some of the key challenges that you faced and victories, and if you have a case study at hand, or that you want to present, or just want to talk through in terms of financials, what one could expect from an ROI perspective, would be great. I know that's a lot, but it would be great to dive into them.
Abby, you want to go first, or shall I go first?
Sure. Yeah, no, you go first.
Sure. I'll share my screen and I can go through an example as well. I would say in terms of challenges, I think the biggest challenge for most people when they're starting out in property is that when you start consuming information, and, you know, I would put this, obviously, you know, us speaking now as more information. The more information you consume, you feel like, well, now I know more and more and more. But the downside of more and more information is that it starts to become even more confusing. So when you start out in something, it feels relatively simple. So if you think about the rent-to-rent model, it seems relatively straightforward that you rent a property, you rent it back out on Airbnb, and you call it a day. But once you start watching content, or maybe you go on some sort of course, and I've got a free 10-hour course on my YouTube channel about Airbnb. Once you do a deep dive, now because you are suddenly aware of all the different things which are involved in the business, that it actually becomes more confusing. So when you know less, it's actually less confusing in a weird way. And so I think that is the biggest challenge for most people, which is at some point you have to, you know, Abby made a good point about this, which is, funnily enough, she didn't do a course and she actually just took action, which I'm not saying is easier, but sometimes mentally it's easier because you're not bogged down by all the things you don't know and all the things which can go wrong and so on and so forth. So I would say, yes, you know, information and webinars and everything else is great, and you need that baseline information, but at some point you have to make that distinction that the only way I'm going to get beyond this point and actually implement and learn something is by doing it, not by watching more and more and more videos. So that by far, I think, is the biggest challenge by far. In terms of case studies, I'll go through an example. I think once you've gone past this point of, okay, well, now I need to take action, it's like, well, how do you take action? They say, well, you know, I always say to people that when you start looking at property investing, you think about it, people think about it a bit too broadly. Say, well, I want to invest in property. You should almost think about it as if, you're going on like Dragon's Den, or you're going on one of these TV shows, and you need to present some sort of one-page business plan that I'm going to, buy this property in this area. It's going to cost me this much money. This is how much I'm going to make. This is how much I'm going to refinance for. This is how I'll pay my investors back. And I think that is the thing which is missing for a lot of people, because it's a bit too generic, and they say, well, I want to do property, but if you then ask them, well, how exactly are you going to do property? Are you going to buy a 1-bedroom flat and turn into a 2-bedroom flat? Are you going to do rent to rent? So getting into those specifics is a thing which is going to push you over the line. And I'll give you an example of one way you can do that. Akesh, I believe I can share my screen on this.
You should be able to. Yes, it's right next to the raise.
It's a share button, right?
Yep, at the bottom.
Okay, give me 1 sec. Share Google document, share screen. Oh, okay, fine, cool. Here we go. Can you see my screen? Can you just confirm?
Yep, I can see your screen.
Okay, perfect. So this is a 1-bedroom flat I bought in West Hampstead in London. So if you look at the before floor plan, you come in through here, you have a bedroom, you have a bathroom, you have a kitchen, and you have a reception room. Very simply, anyone who's a beginner, doesn't have much experience, doesn't have development experience, doesn't want to get planning permission, the list kind of goes on and on. I essentially took this kitchen from here, moved it here. So this room became an open plan living room, and this kitchen became the 2nd bedroom. So if you look at the after floor plan, you can see the kitchen is now there, and this has now become the 2nd bedroom. Unfortunately, the pictures are already tiny on my website, but you can sort of see, well, let me see if I can show you a good picture here. Okay, if you look at this image here, this was the original living room, and now you can see the kitchen has gone in that tiny enclosure there. So in terms of the numbers, I bought this for £303,000, and then I spent £26,000 on the refurb. So this is converting it from a 1-bedroom flat into a 2-bedroom flat. Then you have, legal fees and finance fees and furniture fees and stamp duty and everything else. And 6 months later, this was revalued at £450,000. And once you deduct all of these costs, that made a profit of £61,000. Now, £61,000, given the fact that all you've really done is move a kitchen from this side of the wall to the other side of the wall, I think is pretty good, given the fact that you take a very low amount of risk. So I think this is an example of what someone could do starting out, because, again, the challenge is, the reason I wanted to do something like this is I used to do, like I said, rent-to-rent deals. I never bought a property before. I never done a development before. And so once you get into developments, and, right now I'm turning a house into 5 flats, there's planning permission, and there's, a lot of building regs, and there's, builders who take months and months and months, and you're changing roofs, and there's structural works, and, that list go, you're splitting utilities, splitting addresses. It's a lot of work. And yes, the benefit can be there at times, but that's a pretty big jump for most people. Like, I certainly couldn't make the jump from doing rent to rent into doing a house into multiple flats. Whereas if you're doing rent to rent, or if you're doing nothing and you have a job and you're looking to transition into this, I have never seen an easier strategy whereby you can move a kitchen around and make £50,000-60,000 or you refinance a property and you hold on and you get the bulk of your money back, and you use that to buy the next one. And of course, I've kind of gone through that quickly, but again, I'll plug my YouTube, because there is an 11-hour course on my YouTube channel which goes through this one step at a time. So floor plans and criterias and building regs and everything else. So you can literally just watch the entire 11-hour thing and knock the whole thing out. But I think that is probably the best way a beginner could start if you wanted to start buying properties and start adding a lot of value.
That's very insightful. Thank you.
Perfect. That was so good, Ahmed. So touching on rent to rent, and can I answer some questions in that chat? Someone asked me a question. Can I answer that now, or I have to wait till after?
No, feel free. Feel free.
Okay, so someone said, do I own my properties? Yes, I do. I've got 10 properties. I've been able to get 10 properties by the age of 26. Now I'm 27. So yeah, I do have my own properties. Secondly, so touching on rent to rent, so yes, where I started was rent to rent. So dealing with the ROI in that area, like Ahmed said, it's much more simple, so much more easier. So yeah, so if you don't have the capital of putting 25% more, really and truly 28% on a property, I always lived up north, right? So where I started was Liverpool. And that's because London was just very too much expensive. So I just said to myself, you know what? Where my money takes me, I will go. And that's exactly what I did. So here's an example. When I started, 4 bedrooms, we were looking at a 4-bedroom house, we were looking at £850. So if it's nicely decorated, which will go on to spare room to see that, double rooms, here's an example that I'll just give you just to save time. £500 times that by 4 bedrooms, all double rooms. Obviously, when it's a single room, it's a bit cheaper. So it's for things to make it just much more easier. £500 times 4, that equals £2,000 revenue, right? That's not your profit. So what you then do is just deduct that cost. So 2,000, take away the rent that you have to give to the landlord, which is £850. That will give you £1,150. Once again, revenue. Because if you do a thing where it's all bills included for your tenant, you have to think about the bills as well, right? And so let's say the bills are £350 a month on that house, and that could cover gas and electric, water, Wi-Fi, all of that jazz, in a house. That gives you now £800 net. This is your net profit. And this was the formula that I used with literally all of my properties that I was doing rent to rent in, because it just made life easier. One thing that you should also focus on as well is there will always be maintenance work. Whether you buy a house or whether you're doing a rent to rent, there's always going to be maintenance work that you have to do. So I would say always have money aside for that, because I know not a lot of people talk about that all the time, especially in rent to rent. Even if you got a deal with no money down, you're still going to have to upkeep the maintenance unless you have something different in the contract with the landlord. So I hope that answers your question.
Abby, just following on from that, what percentage of the rental income should one keep aside for these repairs and the maintenance that you mentioned? I know it can vary significantly. What's that safety margin that one should keep?
I would say, okay, so with me, I'm not really good at maths, so I just say numbers. So I would say put like £300 aside continuously. It's not that it's going to be £300, but, if there's a plumbing issue, like there's little things that all add up. If a tenant broke the lock, everything adds up. So I would say put £300 aside continuously, just so that's your safety net as well.
And is that on a monthly basis?
Yeah, I'll do on a monthly basis, just because then it's not eating into your profit. It's just, when it comes to property, money management is very important. And it's so easy for people to just get excited about the money and then they'll splash it. This is why you have to, put all of these things aside in order to upkeep your maintenance.
Okay. Very insightful. So I guess moving on to the next topic, I'd say let's split the different business models. So I guess Ahmed, you can go on. You can talk a bit about the service accommodations, as that's what you got started off with, and Abby, buy to let. So if I was to say there are 3 different profile of listeners today, one is someone that's 21 to 25, just gotten started, similar to yourself, and wants to get on the property ladder, wants to start off within the property segment. How much money do they need? How should they get started? What kind of ROI should they be expecting? The second is someone that's in their early 30s or mid 30s, has a stable career, has decent income, and wants to essentially start building out their property portfolio. And then finally, I'm in my 40s, let's say, I've got a really, really great career, and tons of disposable income. Now I essentially want to build a portfolio that essentially could set me up for complete financial freedom in a 10-year, 5-year time frame. It'd be good to dive into, I guess, those 3 profiles.
Yeah, so I think the profiles are very useful, so to get an idea of where people are. But at the same time, each of those profiles could do rent to rent, or each of those profiles could also do buy to let, depending on where they are. So it's a bit more challenging. I think the distinction I always make is that if you have capital, so let's say you have, I don't want to put a limit on it. It could be more, it could be less. But if you have money to start buying and developing properties, I think wherever you are in that spectrum, you should start doing that, because if you can get on that property ladder and you can start buying and developing, and you can you can build a skill of actually adding value to properties, money becomes less of a limitation, because once you have some credibility and some experience, you can then start raising money. Because once you have a case study, you can then show that case study to investors and say, well, this is what I've done previously, and I'm happy to work with you, and can come up with some sort of profit split or some sort of joint venture agreement or some sort of loan agreement. It's like you have plenty of options. And so I always say to people that the credibility and the experience is probably more important than anything else, because that is what you use in order to raise money. If you think about any sort of startup, they prove a concept, and once they have the concept proven, then they raise money against that concept. But on the flip side, if you're in a situation whereby, let's say you have £3,000, £4,000, and you don't have enough money to buy a property, of course, rent to rent is going to be the easier alternative, purely because, well, you can get started with £3,000, £4,000, and similar to what I did, you can take on one rent to rent property, use that to make money, and then now you have £4,000. You're making, let's say, £600, £700, £800 per month. You save that up. You buy the second one you rent the second one in a few months. Well, now you have two making £600, £700, £800 a month, and that can snowball very, very quickly. But at the same time, there's pros and cons to everything. I think the pro of service accommodation is the fact that it doesn't take much money, and the return on investment can be astronomically high. The downside is it takes significantly more time than doing something like buy to let, and is riskier than doing something like buy to let, because it's a lot more volatile. You asked a question about ROI. It's hard to give an answer on ROI, because for example, there was this lady doing rent to rent in London, and I spoke to her a while back. In 1 month, she made £3,000 in net profit. I've had months where I made £3,000 net profit on certain properties. But by that, by no means is that an average. You might have months where you might make £200-300. Now, of course, yes, things average out, but areas change, and so on and so forth. Put simply, I wouldn't worry so much about ROI, because if the rent-to-rent property works, you're going to make more than 100% ROI regardless. If you're in a good area with a good deal. The challenge is having the right property in the right deal, and so on and so forth. So the way I think about it is, if you have a low amount of capital and you're willing to take a risk and take a chance, I think rent to rent is probably the best option. If you have capital, there is still some rationale to do rent to rent, because you can build that up over time slowly, because you can generate more and more money. But I do think if someone has money to buy properties, yes, it's slower because it takes a lot longer in order to build a portfolio. But if you can just get that first one and you can build a case study, you can very easily raise money for property number 2, 3, 4, and 5. And so in 10 years' time, I would rather have 10 properties I own as opposed to 10 rent-to-rent properties. So I'm always, trying to think from that point of view. I'm not sure if I've answered the question, or was the question like, should you do rent-to-rent?
No, I mean, definitely. I guess just following on from that, let's say I have 100,000, 50,000, anywhere in that range, but you still would need a sort of income, let's say, on a monthly basis, so that the bank can lend you, I don't know, 4.5x that property, right? And so essentially you would still need that kind of initial job to get started. And then I guess following on from that, I guess it would be good to kind of dive in a bit in terms of how you would raise investment. Let's say you were able to go over the first hurdle.
In the situation where you're doing buy to let? Yeah. Well, I think if you can get the first one done, I mean, by the way, you don't necessarily have to get the first one done. I think it just makes life easier if you've got the first one done. Once you have done the first one, you can quite easily make some sort of investor deck or investor pack or some sort of case study, and then it's a blank canvas. You can say to an investor that they put up the money, you do all the work. So, for example, I had a call with someone literally a couple of days ago, and their pitch to me was that they're willing to put up all the money, I do all the work, and then we go 50-50 on any profits. in that situation, we would actually just hold the properties and rent them out for the foreseeable future. But any equity we make or any cash flow we make, he's happy to go 50-50. The reason is he has capital, but he has no time to find properties, negotiate, do the work, fill in the paperwork and everything else. So he is more than happy for someone else to do all of that, and he'll take a 50% cut. And so I think if you can find investors like that who are happy to put up the money and be very, very passive, and they believe that you have the credibility and the skill set in order to do the work, then that's all you really need. You just need a few of those people, and you can just keep replicating that cycle again and again. But I do think that credibility box and the experience box is probably the most important thing. But it's still going to be slow because it takes a while for you to raise money and buy the next property and then refinance. But I just think that's a better longer term model, because you end up with properties that you actually own. You benefit from capital appreciation. I think over the long run, rents will continue to go up and up and up. Mortgage rates will eventually come back down, and so I think that's the ideal place where you want to be. But if you don't have that option, I would stick with rent. Like, for example, if I could go back in time, would I do the same thing again? And the answer is probably yes. Because when you have no money, it's like, well, what would I change? It's like I still think that was the best move at that moment in time. Now, if I had finished university and I got a job for 5, 6, 7, 8, 9 years, and I somehow saved up 50,000, 100,000, 120,000, I would probably just start buying properties. But in the situation I was in, going back, I would just repeat the same exact process again.
That makes a lot of sense. I guess since we covered buy-to-let with yourself, Abby, should we go over service accommodations, how one can get started within this space? Is that a model that you cover?
Yeah. Well, I touch more on like the HMO side, but service accommodation is very similar. But I touch more on, I feel like, Ahmed, you do more of the service accommodations, don't you? Yeah, I do more the rent to rent, which is room by room, similar, but it's not, if that makes sense. Do you know what I mean?
Mm-hmm. Well, I guess let's go into what the difference is for the audience, and what the difference is in terms of the model from an operational standpoint, and then also like what the difference are in terms of returns. And again, this is more rule of thumb, so not necessarily like calculating one. Just quickly, we've got a series of questions from the audience. We will be diving into them in the next 5 minutes. So rest assured, please do keep them coming in.
Yeah, so regarding rent to rent, HMOs, for example, we do room by room under AST contracts, so they stay for longer term. That's more stability. And it's for anybody who honestly just wants less headache. Unless you don't have a team, because let me say it right. When it comes to this, when it comes to service accommodation, there's a lot of people that come in and out, in and out, in and out. So that means there's more maintenance work you have to upkeep. And at the same time, you have to be more hands-on. But you can have a team in place to, systemize it all, so you're not having to deal with it. But with that, I know that it is higher rewards as well. Because if you have a good month or 2 or 3, you're gonna get good rewards. So let's say on a normal, so you know what I said about the Liverpool property, that was a normal HMO, right? That was £800. Now, with a service accommodation, you could do it at a higher rate in like per night, which is just like a hotel. And you guys already know how a hotel works. So in saying that, let's say that property does, imagine you're making £3,000 because of that. So, there's a lot of, there's risk, but there's rewards in everything it is that you do. So that's the difference between the both, to be honest. So, yeah.
The other thing I would add on, the difference between rent-to-rent HMO, rent-to-rent service accommodation is, I think service accommodation feels more like a traditional business, because it's almost in the hospitality space, whereas it's almost not a property strategy. I know it's categorized under the world of property and under the property umbrella, but it's more similar to a hotel and hospitality as opposed to property, because HMOs, you have tenants. Service accommodation, you don't have tenants, you have guests, like a hotel would. And so you have very different systems and processes and marketing and operations. And I have virtual staff in the Philippines who manage a lot of the day-to-day and so on and so forth. So I think that's probably the main notable difference. And then on top of that, with service accommodation, you could technically start with a studio. The first property I ever rented was a studio apartment. Now with a HMO, that would be slightly tougher to do because you need multiple rooms in order to rent out and make a profit there. And so sometimes I find that I feel that it might be cheaper to start with a rent-to-rent service accommodation property, purely because, well, you can start with a studio and all you have to do is furnish one room. So your startup costs, assuming you have the right area and the right property, are minimal. You can start for like £2,000, furniture included and everything else included. But, to Abby's point, they are different. Service accommodation does have a lot more workload. If you don't have good systems and processes with service accommodation, you would end up getting buried with work very, very quickly, purely because it's one of the few businesses in the world which is 24/7, 365. Like, there is no time when it closes. Someone can be checking in at 2 a.m. The next day, someone's checking in at 4 p.m. So unless you have a good system, a process, a channel manager, all those sort of things in place, if you have a job and you're trying to do that with that systems and processes, it would turn into chaos relatively quickly. Whereas with HMOs, that wouldn't happen as much, because once you have the tenants in, you're not going to get the same amount of churn that you will with service accommodation. But I agree with Abby. It's pros and cons, really. I like the service accommodation model because I think it's potentially a bit more scalable, and once you have the systems and processes, the upside can be great if you have like some really good months. I've had bookings where for example, with service accommodation, you get a lot of insurance companies who end up booking your property. So imagine your house has a fire or something and you need to be relocated. Well, that then goes to service accommodation. I've had people book for 9, 10, 11, 12, 13 months, paying by the night, paying 150, 160, 170 pounds per night for months on end. So when stuff like that happens and you can get involved in that space, you can make a significant amount of money. But to Abby's point, it's pros and cons. One's more time consuming, one's less time consuming, one's more stable, one's more volatile. And so it's just a case of picking what's right for you. And it's also a case of picking what works in your area. So I live in Stevenage in Hertfordshire, and HMOs, there's Article 4. So HMOs are slightly tougher where I am, but Airbnb works really well where I am. So if you want to stick to your area and your vicinity, you also then have to ask the question, what's going to be the best strategy for my budget in my area? And if you don't want to leave your area and the only thing that works is HMOs, well, then you might have to stick to HMOs. Whereas if you don't want to leave your area and the only thing that works is service accommodation, well, that's sort of the avenue that I would pick. So yeah, this strategy thing is probably 80% of the battle, trying to work out what to do and where to do it. I think if you can answer those two questions, the remaining is like 20%. The bulk of the battle is, what do I do and where do I do it? That's certainly been my experience.
Very interesting. I guess just following on from that, with the service accommodations, correct me if I'm wrong, you also have, alongside the upside, there's also some risk inherently built into it, meaning that if you don't have the right kind of operational system in place and you aren't able to get the type of booking, you're still committed to pay the rent on a month-on-month basis, right? And so you're basically locked in for, let's say, 6 odd months in terms of with your landlord, and are committed to make that payment. And if you aren't able to get the bookings, you essentially run the risk of more than what you had invested. So let's say you've invested 2,000 into this property, and that's essentially all your funds, but aren't able to get the bookings, you're still going to have to find that way to fill that rent, right?
Yeah, for sure. To be fair, that risk remains with both renter and HMO and renter and service accommodation, because, well, you still have to, you got to pay the rental in both cases. But yeah, you're absolutely right. I think with service accommodation, I always say to people, anytime someone approaches me with questions about service accommodation, I always say to them, 90% of service accommodation is picking the right property in the right area. The remainder of it is 10%. So people all the time ask me about, pictures and channel managers and linen and lockboxes and check-ins and everything else. Literally none of that matters. I had 6 Airbnb rent-to-rent properties. I didn't have a company account set up. I was still, working on some account setups and everything else. The check-in process was I was leaving keys under doormats, and I would just say the keys under the doormat. That's how they would check in. When they would check out, they would just put the key back under the doormat. There was no channel manager, so every now and then I would get a double booking. I once had someone booked a property on Airbnb, and they went to sleep, and then someone else checked in from booking.com. Now, obviously, they didn't stay in the property, but if you don't have the systems in place, stuff like that happens. But my point is, I had no channel manager, no bank account, no check-in process. Cleaners, every other day I was switching cleaners because I hired the first company, they turned out to be crap, hired the next company, so on and so forth. So nothing worked. Everything was, a bit of a crapshoot. But the only thing which did work is I had a good property in a good location, which meant I continuously had more and more and more bookings. The inverse of that would be that you have an area, or you have a business whereby you have the best systems and processes and marketing and linen and check-ins, but because your area isn't good, you have no bookings. So none of that matters. You can have the worst shop in the world, but if it's on Oxford Street, it's like someone's going to buy something. Whereas you can have the best shop in the world, but if it's in the middle of nowhere, it doesn't really matter how good the shop is. So I completely agree with that in terms of the risk factor, but I think if you spend 90% of your time just on area research and just on deal analysis, you can easily overcome that issue. But the problem is because people spread the time evenly, so they say 20% on area analysis, 20% on systems, 20% on marketing, 20% on cleaners. The weighting is off because the bulk of the results come from the first category. Everything else doesn't necessarily generate a result. It helps you fulfill operations, but that's not the thing which makes you money. So yeah, I completely agree with the point about risk. And I think partly the issue is that where people are spending their time is a bit off. It should be focused, on area research and deal analysis. Not on all of the rest just does not matter. Like it literally does not matter.
So I guess it's that 80-20 rule, right?
For sure.
20% of your efforts would get that 80% of that result. So, well, thanks for that. Well, I guess let's dive into some of the questions that our audience has got in here. Apologies if I butcher some of the names. So Ashley has asked to Ahmed, would you say your 1 to 2 bed BRR strategy that you did in 2018 and that you've done your course on, has it changed at all? Would you recommend someone any different advice if they were to execute on it now, other than the interest rate and the cash flows?
No, I think the only thing which has changed is, like the comment says, interest rates and the cash flows, for obvious reason, because the rates have gone up. I just finished mentoring someone right now, and in August, they bought a slightly different strategy. But again, in London, they bought a 2-bedroom house for £300,000. They refinanced last month at £450,000. So they achieved similar numbers to I achieved, but they didn't do a 1 into a 2, they did a 2 into a 3. I'm mentoring another person right now. He's just bought a 1-bedroom flat in Kennington, so he's turning that into a 2-bed. The refurb will be done within the next few days, and of course, we don't know what's happening with the refinance yet because it's still in the refurb stage. But ultimately, the principles are still the same, which is you have to buy at a good price and you have to add add as much value as possible. But yes, the cash flow for the foreseeable future is going to be lower than what you would normally expect because the rates have gone up. But beyond that, I think it's no different to what it was before.
Amazing, thank you. Let me just. Oh, great. So we are joined by Gordon, who's our expert property accountant. He has over 35 years of experience advising clients within this space. And off the back of this Q&A, you guys have the opportunity to ask Gordon any accounting / finance related questions that you have within this space, and stay tuned till the end as we've got a special gift for all of you guys that have attended. So I guess a question from Vivek. So 1 second. A question from Vivek. to Ahmed, do you need to inform the council, HMRC land registry, or the freeholder, as I have changed the floor plan from 1 bedroom to 2 beds? Thanks.
Okay, so when you turn a 1 into a 2, the only thing you need is called freeholder consent, i.e. you need permission from the freeholder. Now, if the freeholder is the council, you will get that permission from the council. If the freeholder is not the council, so it's a private company or a housing association, then you will get permission from the private company or the housing association. Because this has nothing to do with planning permission, it technically has nothing to do with the council, because it's not planning permission, it's not permitted, it's kind of permitted development, but not really. It's just an internal reconfiguration. So no need to get in touch with the council unless the council is a freeholder. HMRC, land registry, those sort of things, most of the time when you buy a flat, when you buy the title deeds, it doesn't actually show you the internal layout of the property itself. All it does is it just shows you the boundary of the property. So it'll be like a red box or something which shows you the building and then the flat within the building. But it doesn't show you, well, the kitchen is there and the bathroom is there and the bedroom is there. So there's no need to get any of that changed. And land registry deeds, they normally don't even mention if it's a 1-bedroom flat or a 2-bedroom flat or if it's a studio. All it shows you is essentially the red boundary. So you don't have to get a lot of that stuff changed.
Thanks for that. I guess there's a few more questions for yourself, Ahmed, but we'll move on to Abby and then come back to yourself. Abby, a question from Kasimu. I'm doing a R2R SA. I assume that's an acronym, one that you'd probably understand, but by looking to focus on R2 HTMO, I have JV, overseas investors, working with me. I just need advice on that strategy.
So where you work with investors, what I'll definitely say is what will be easier. It's totally up to you how you work it out with them, but because I did a lot of angel investing as I was growing my rent-to-rent portfolio, you need to figure out an amount that is doable to pay them per month, or if they're happy with it, a yearly one. So after the 12 months, then you pay them back. It makes life more easier. You won't need to stress every single month, just in case your property is not, upkeeping the way that you want it to be, but then you're still having to pay them per month. That's how you should strategize it. And for every investor, be very specific on the deal. Make sure your contracts are tight and it makes sense for all parties. And at the same time as well, make sure you do your due diligence in that specific location. As I said before, when it comes to rent to HMO, it's much more easier in a sense where all you simply have to do is look at the demand in the location, look at the average rent as a family home in that location as well, which will go on Zoopla for. And then after, going to spare room to see, room by room, what does that average monthly it goes by, like Liverpool 450 to 500 or more, depending on that location. So make sure you do your due diligence in that area. So when you do present it to the investor, everything makes sense. And also make sure the contract that you have with the landlords, make sure that makes sense as well. And, there's no issues there too, because the last thing you want to do is get investors' money and the landlord now takes it away from you.
Thank you. A question to Ahmed from Aranus. I've been renting out 2-bedroom apartment on Airbnb and Booking.com. However, there's been a significant gap between the projected ADR of £180 and the actual average of 110. I'm achieving over the last 3 months. Do you think AirDNA's data is reliable, or should I explore other options?
Yeah, so if the data says you should be renting it out for £180 a night, I would take the AirDNA data with a pinch of salt, because it's one source of information, and it is a bit of an average across different property types and so on and so forth. Whereas if you actually go on Airbnb and look at what other people are renting their properties for, or if you go on Booking.com and see what other people are actually renting them for, you'll probably get a better representation. The other thing in this could be that, like I said, because AirDNA is a yearly average, it might be that once you account for the summer months and the winter months, on average it's 180. So in certain areas, maybe in the summer months you can charge, 210, 220, but in the winter months, the last few months, maybe you have to charge 110, 120. So I to answer the question, I wouldn't take the ADNA data at face value. I would treat that as one source, but I think the best source is Airbnb and Booking.com. But also just keep in mind that, well, it might just be an average across the year, and so rates generally tend to get significantly better in the summer months compared to in the winter months. So if you shoot me a message on Instagram, I can have a look for you, but that seems to be my hunch.
Great. So I guess a follow-on question, part one, you've already answered for Arnes, in the sense that he's feeling somewhat discouraged due to this discrepancy between this data. However, he is curious to know your thoughts on the upcoming regulations for short stay lets.
Yeah, I don't have too many thoughts for the time being, purely because it's something which was discussed, but at the same time, no one really knows when that would actually come into fruition, and how long that will take, and if it will actually happen or not. Now, I don't think this is new. When it comes to regulation, they've been talking about it for years and years because of the London 90-day rule and everything else. So I'm not saying you shouldn't pay attention to it, but at the same time, it's very hard, if not impossible, to say if something will come in and when that will come in. I think especially if you're doing rent-to-rent, one of the big benefits is the fact that if something was to ever happen, you can just terminate your agreement and you can part ways without really incurring any cost or any real downside. That is the one big benefit of a rent-to-rent business, which is the fact that it is very, very nimble. If something was to happen in 2 years' time, well, you make money for the next 2 years, and if you have to pack up for whatever reason in 2 years' time, well, then you can get out very easily without incurring any cost. You generally can't do that with most businesses. If you, I don't know, started a restaurant, you might have a 10-year lease on that, on that property. You might have spent tens of thousands in terms of furniture and cooking equipment and everything else. Whereas rent to rent, most of the time you're profitable after year one in terms of you've made your furniture money back and your deposits and everything else. And beyond that, if something does happen, well, you still have the flexibility of making money in that within that period, and then exiting without any cost. That's how I would think about it, as opposed to the regulation and everything else, purely because no one knows. It could be next year, it could be 5 years. And so because it's not something you can control, I don't see much benefit in giving it too much thought.
Great. So I mean, I can see that we're running out of time. Are you guys okay to continue answering questions for 5 more minutes?
Yeah, I've got till 5 p.m, so I'm good.
Okay, great. Amazing. So let's jump back onto Abshley. We've had 2 people upvote this question to Ahmed again. I'm aware that some lenders look for age and experience, especially for bridging. You started your 1 to 2 bedroom BRR under the age of 25. What net LTV did you achieve for your bridging, and how can you maximize this? I'm aware you did have an older and more experienced business partner. Did this help?
So the first loan to value, I think I had 75% loan to value gross, which normally means 65% loan to value net. There are conditions when it comes to getting these loans and stuff, but a lot of them are not that strict. So I would say if you get in touch with a broker and you essentially outline your situation and how your age and experience and everything else, you should be able to get some sort of finance. And I think, again, going back to the 1 bedroom into a 2 bedroom, yes, I agree that with bridging finance, sometimes you need experience, but the 1 into a 2, it's mainly just cosmetic work, and you barely need any experience, if any. If you've, like, for example, done a refurb on a house, even that's considered experience. And actually, the last time I spoke to a broker about this, if you have experience, you can then you can borrow even more money. So to hit that baseline of 65, 75%, as far as I'm aware, you should be able to get without any experience whatsoever. So, if this person wants to drop me a message on Instagram, I can put you in touch with my broker, or you can send your details, and you should be able to qualify for something. If I had started with turning houses into flats, I think more experience is required there because there's planning permission, it's a much larger development. But stuff which is cosmetic, you generally don't need as much experience. So no harm in asking the question and seeing if you qualify. And I think there's a very high chance that you will qualify.
That's Great, thanks for that. So I guess we've got two questions for Gordon as well, but before I go into that, let me just share my slide. As I've mentioned, we do have a unique gift / discount for the audience that has attended. Let me just share my screen quickly. So for those that have attended, we are offering up to £100 off on our accounting packages. You can sign up via either scanning this or clicking on the link below, or if you speak to one of our sales team members, we mentioned the discount code webinar 100, you'd be able to claim this discount. So now I guess on to Gordon to have a little deep dive in terms of the question. So Gordon, to yourself, Mirza is asking, rent to rent, what can I throw down as an expense generally, and what does the new SA rules coming up go into effect taxation?
Okay, well, it depends. Obviously, there's not a huge amount of expenditure in a rent to rent because there's no capital expenditure. So I'm guessing we're talking that you already have the property and it's just what can you offset against the rental income. You're not going to have a huge amount, obviously, because I'm old enough to remember that if you had a mortgage, you could offset mortgage interest against any rental income. Those days are long gone, obviously. So you're just going to have your generic costings as such. So you would have maybe some use of home as office that you could claim for use for it, any cleaning that's done for it. So it's the basic expenses. Unfortunately, there isn't a great amount, and I'm sure Ahmed would agree that he wishes there could be some more expenditure offset against his income, but it is pretty low in terms of a rental property.
Thanks, Gordon. And a question from Ahmed. How is it best to set up a limited company for inheritance tax planning for future? I've seen some stuff on using different classes of shares.
It's a difficult one because when you're talking about limited companies and properties anyway, you've got a difficult decision to make, and I'm sorry I've obviously joined you guys later that you might have touched on this already. Obviously you have implications if you have one property, for example, in your own name and you're looking to expand that business, you've got a real decision to make in terms of whether you make it a limited company, because you obviously have to have ownership of that and those properties in the limited company or as an individual. So you're talking about stamp duty, etc., that comes into play. So you really have to weigh up whether a limited company is the way to go with these things. And so in terms of sort of setting up for inheritance tax going forward, it really depends on the number of properties, values, etc. It's a little bit of a difficult one to answer that without knowing specifics, unfortunately.
Sounds good. And I guess just a follow-on question for someone that is planning to purchase the second property, would you recommend them incorporating their company or doing it on their own name? And what are the implications of either of those approaches?
Well, this is sort of as I touched on in my previous answer. I think you've got to look at the longer term. There's pros and cons to being a limited company. There's pros and cons to leaving it in your own name as such. Obviously you get the relief in the capital gain, but that's dropped significantly over the past few years. I think no fewer than 2 or 3 years ago, I think the allowance was 12,000. It's now 3,000 in the current tax year. So it is a significant drop. You're only on residential property. If you're a standard rate taxpayer, then you're only going to pay tax on the gain of 18%, 24% if you're a higher rate taxpayer, whereas in a limited company, everything is obviously at 19% until you hit the magical number where it jumps to 25% if your profits exceed 50,000. So again, you've got to do your sums, think about where it's going to be. There's no right or wrong answer. Technically, it purely depends on that individual, what the plans are, etc. And I'm sorry if I sound really vague on that, but it really is a case of, we used to be able to give advice that was much more generic to where somebody was looking to go. Now it really is specific to that individual and what really will work for them and what the plans are for the future.
Sounds amazing. So I guess a question to Ahmed. But since the bulk of the questions have been to you, Ahmed, I'm going to direct this to Abby. And this is from Ahmed. Please, could you list some things that you should keep in mind or consider when doing your first project that will make it easier to raise finance in future projects? Documenting the process via video, other things which can help raise investment later on.
Hi, okay, thank you. So regarding me, so how I was able to raise finance is, yeah, documenting your journey is so important. With me, throughout my journeys of buying my 10 houses, I literally documented everything and then put it into a whole little mini documentary on YouTube. This is good because this builds trust with your audience. Also, what I did was I am continuously active on social media with my journey and how everything's going. This is very important as well because people need to trust you as a person and they want to see like you're really in your business and you're continuously going on about it. And it's all about the way you market as well. If you present it in a way of you showing investors that I'm using your money I'm helping you basically grow interest in your money, a lot of people would want in. And what I did was I created like a PDF for them as well, for them to have further information and jumped on calls with them too. Because what you need to know is whoever you do get money off, you need to know their situation, their background, etc. So then you have no issues down the line. But yeah, that's exactly what I did in order to grow. And that's what you can do too.
Yes, thank you. And then if, I guess a question to Gordon, if you buy your second property in the company name, is this treated as a first property in the company or not? And what happens to stamp duty?
In terms, sorry, I don't follow what they're actually asking there. So they've already got one property, what, in the company or in their own name?
Second property in the company name, I think they just type in own name. There we are. So if they have a property in their own name and they buy the second property in the company name, is this treated as a first property in the company or not? And what happens to stamp duty?
Yeah, absolutely. It's all to do with legal ownership. Obviously, legal entity in its own right is the company. So therefore, if it buys the property number 2 for that person, then it is technically the first property of the company. So in terms of stamp duty, it works in the same way. It's a first purchase in that respect.
Thank you. It looks like we have another time for one more question before we wrap up. Let me just go on to the final slide for anyone that does want to claim this discount. Now, this is a question from Josh Edwards to Ahmed. How do I add the most value to a one-bedroom property that already has an open plan kitchen?
Yeah, so typically because I turned it from a one-bedroom into a two-bedroom, and the rationale, the rationale behind it is that you want to spend the least amount of money in order to get the biggest amount of uplift. And so reconfiguring properties generally doesn't cost that much, but you end up with another room. Whereas if you had a one-bedroom flat and you were building an extension to get a second bedroom, well, now you need planning permission and development and everything else. So if you have an open plan living room, it makes it harder because you can't convert the kitchen into the second bedroom. But if this open plan living room is a pretty big open plan living room and it has 2 windows, so imagine one side of the living room is open plan living room is a living room area and the other side is the kitchen area. If the kitchen area has its own window, maybe you can build a wall, partition that off. And so that's essentially the same thing as an enclosed kitchen. You would then turn the kitchen into the bedroom and move the kitchen into the new open plan living room, if that kind of makes sense. So you're basically turning it from an open plan living room into a non-open plan living room and then back into an open plan living room. But it's just you have to create that second room. Or towards the living room end of the site, if you have a window there, maybe you can just create a stud wall there and that end of the room becomes the second bedroom. So as long as you have 2 windows and the room is big enough, you can still do it. It just depends on the layout of the room and where the window placements are. So again, send me the floor plan on Instagram and I can sort of draw a quick line for you to show you what I mean. But hopefully that makes sense. Just have to partition the room somehow in order to get that second bedroom.
Thank you, Ahmed. I guess one final question, and this one's to Gordon. If you loan your company money interest-free to cover rent and other costs on short term, how would you treat that repayment? How would you treat that repayment back to you, or that amount back to you?
Yes, so that's not classed as income, so it's not a declarable situation as regards to that. That's just a loan repayment. So as and when the company can afford to repay it, then it can be repaid without any declaration required to HMRC. The only issue will become if you decided to do it as an arm's length transaction, including interest. So if you were charging your own company interest to do that, then you may have to declare the amount of interest that is paid as an income source.
Amazing. Well, thank you all for joining this discussion. I think it was very insightful, judging by the fact that everyone that logged in has still kind of remained through with us till the end. It was very engaging, and at least for me, I found it very insightful. So thank you, everyone that joined. Ahmed, Abby, Gordon, appreciate your insights. And for those of you that may have missed parts of this discussion, we will be following up with reminders as well as a final couple emails just to share some insights off the back of this conversation. Thank you all, and hope to see at least you guys on the panel soon.
Cool. Thank you for having us.
Thank you.
Thank you, team. Bye.